Hello and welcome to the Investment Coffee Break. Now, today we're asking the question, is cash king? We've all seen bank and building society cash deposit rates increasing of late. And so many clients are asking the question, is this a viable option for my money? Joining me today are Adam and Joy, two of our investment managers at our Winchester office. Joy, can I start by asking, when we look back at 2022, which we all know was a very challenging year for markets, I would have been better off if I'd invested in cash at that time, wouldn't I?
Thanks, Andy. Well, yes, you're right. If you look at the short term in isolation, then cash has certainly seemed very attractive. So here we have a graph of what happened in the calendar year of 2022. And you can see that cash is on the dark blue line there, and that's gradually going upwards as interest rates have increased. We can then compare this to world markets on the light blue line, and that has actually offered lower returns than cash over that period. So here we've picked world markets, but to be frank, we could have picked the US market, the UK market, or even bonds, and cash would have still outperformed.
Okay, and so how does that look if we wind forward to, say, today's date?
Yeah, so if we extend that graph out, so the same graph out to include 2023, that you can see that whilst 2023 still hasn't been exactly brilliant in markets, you are pleasingly starting to see some market recovery. And global markets have just overtaken the cash returns since the start of 2022. What we are really doing here is zooming in on the short term and looking at a period where cash has outperformed. If we take a step back and we look towards a longer term time period, so 5, 10, or even 15 years, then we will see that it's actually markets rather than cash that have outperformed. So whilst over the shorter term, you can always find periods over history where cash has outperformed stock markets, say a month, 6 months, or even a year, it's the long term that we can look at and see that actually it's markets that tend to outperform. And on this graph here, we've chosen a 5-year period. And again, we can see markets on that light blue line well above those cash returns that we can see there on the dark blue line. And although cash may be a little bit less volatile, you would have made much more by investing rather than holding cash over that period.
Okay, so and I can clearly see the markets outperforming cash there, but I can also see if I look towards the end of that cash line, that uptick, and obviously that represents the increase in cash or the increasing in cash rates. Does that mean that cash is more attractive than it has been of late?
That's a really interesting question, actually, Andy. In fact, there has been this perception, especially of late, that cash has become a much better investment than it has been over the last decade or so, because we have seen interest rates increase. But when we look at this after the effects of inflation, cash is actually a much worse investment than it has been for the past decade. And that is because whilst interest rates are relatively higher than they have been, inflation is even higher than those interest rates. So that's actually causing a drag on your cash. And what that means is when we consider our cash after the effects of inflation, you're actually losing money. So on this graph here, we're adjusting those cash returns against these inflation figures. So we can clearly see that whilst interest rates are higher now, they're just not enough to offset the impacts of that high inflation. And that high inflation is eroding the real value of the cash we have. And that's exactly why we see on the blue line of cash that's falling in real terms over the last 5 years or so. What's then really interesting is when we add markets onto this graph. So when we add on that light blue line, which dictates markets for us, we can see that investing actually protects much more against inflation than cash. So over the longer term, whilst cash may look more attractive and you're getting more in your bank, it's actually looking after inflation that's really important to see what cash is doing for you.
I think it's worth adding that the other consideration at the moment is that you might lock into a fixed cash rate for the next year or two. However, at the point those fixed rates expire, it's very likely that interest rates will be much lower, and there's a good chance that markets have recovered. So you can miss the opportunity that currently presents itself. I think that also brings us on to another good point that, where you're attempting to sell out or finding the best buying opportunity, it's almost an impossible task, especially when you realize how much of a portfolio's gains over time can be attributed to just a few days of really quite stellar performance. These best days in the market also quite often tend to come after a period of depressed markets, which is obviously what we've seen of late. This chart here helps to highlight this point and shows the impact of missing the best days in the market over the last 34 years. What you can see is that you've invested at £10,000 back in 1986. If you just stayed invested over this period, it'd be worth over £180,000. Whereas if you missed only the best 10 days in stock markets over this period, that would reduce to around £100,000. And quite profoundly, missing the best 30 days, which is 30 days over a 34-year period, that would reduce the returns by a staggering 78% to bring the value down to around £40,000. So, whilst this is advice we obviously give to existing clients who are currently invested, it's when markets are low and it feels most uncomfortable to invest that usually provide the best long-term buying opportunities. So for new clients looking to add to existing portfolios, we think it's an attractive time. And as Warren Buffett says, be greedy when others are fearful.
Okay. So if we are investing, then where exactly should we be investing? Where are the real opportunities as we see it?
Yes, I think we see a lot of opportunities out there. We've not got time to go through this in granular detail, and we've covered some of those specific opportunities in previous coffee breaks. However, looking at overall level, we can see that some markets and companies are looking cheaper than they have historically. To highlight this, the chart we have here is the UK FTSE All-Share Market, which comprises around 600 companies. What this shows is not the actual returns of the UK market, but how cheap or expensive the market is, looking at the profitability of companies versus their share prices. What you can see is that the UK stock market is as cheap as it's been for the last 10 years, with the only time that they were cheaper being the financial crisis, which is obviously quite a deep recession and really not the environment we find ourselves in today. To put some meat on the bones here, if you'd have invested at the previous low valuation points you can see in 2009 and 2011, when markets were cheap, the subsequent 5-year returns from those points were 64% and 40% respectively. So it's that famous saying of sort of buy low, sell high, and we're at a similar sort of level today. I think it's worth adding as well, whilst we wouldn't want to buy the whole market in the UK, and this applies to other markets globally too, this does demonstrate the value on offer, and when we can drill down further to ensure that we're buying very high quality companies that have the ability to grow faster, and also importantly, protect the client's capital on the downside as well. I think another sort of investment opportunity that we're seeing is in investment trusts. And this is something that we hold within portfolios and have been active buyers of over the year. As well as stock markets looking cheap, as I've just touched on, investment trusts are collective investments that are trading on the stock exchange, and they can invest in many different areas. They include stocks and shares, as well as other assets such as property or infrastructure. Now, because they're listed on the stock exchange, when you have times of poor sentiment, such as what we have at the moment, you can have periods where the stock market valuation or the share price moves below the value of the underlying assets. This is known as trading at a discount. Whilst it's not unusual for investment trusts to trade at a slight discount to their underlying value, or net asset value as it's known, at the moment the whole investment trust sector is trading on a discount of over 15%, which is quite rare and unusual, and actually, again, not too dissimilar to what we saw back in 2008. So we think this provides a great opportunity to buy investments that are significantly undervalued for clients that are prepared to take a medium-term view, as we can benefit from this discount narrowing, as well as the performance of underlying assets. We've also seen many trusts start to buy back shares to help narrow that discount. I think the final sort of opportunity that I'd briefly touch on is around UK government bonds, otherwise known as gilts. Again, this has been covered in quite some detail in a previous investment coffee break, but just to kind of highlight what this is, gilts are effectively a UK government bond where we're lending money to the UK government at an agreed rate of return over a set time period. This is effectively guaranteed by the UK government. So to give an example here, we have a specific gilt on the screen here. To talk this through, it's a UK government bond that matures in January 2024. And if we hold it to redemption or maturity, it provides an annualized total return of just over 5%. So this is similar, really, returns that you're getting at the moment. One of the additional benefits of buying UK government bonds is that they're creating capital gains. You can therefore buy gilt when the majority of the returns come through capital gains rather than income. This compares to interest on cash on deposit, which would be liable to tax. So we can therefore see on this table here that if you're a higher rate taxpayer and you invest in these gilts, you would have to get the equivalent interest rate of 8.2% to achieve the same net return. So we think this is very attractive at the moment. And this is just one UK gilt that we're using to highlight the opportunity. However, within portfolios, we do hold a number of these investments with different maturity dates. I think one of the advantages of holding longer dated gilts is that we can lock into the returns from longer. And also, as interest rate expectations start to fall in the future, we can see some capital gains come through here as well. And you certainly don't get that sort of return and opportunity on cash as well. So some very interesting opportunities across the board.
Excellent. Thanks, Adam. Joy, can I ask for a quick summary?
Yes, absolutely, Andy. So the good news here really is that we can see very good opportunities across all asset classes now. So whereas historically it tended to be equities that we look to, we can see some good opportunities in bonds, equities, as well as alternative investments, especially for those clients that have a medium to longer term time frame. And we can utilize those low valuations and those low prices that Adam's mentioned to our advantage, as well as those tax efficient investments such as gilts, where we can lock in good returns with potential for capital growth and with the ability to switch quickly into other areas where we see opportunities in the coming months or years. So the reality really of the situation is that the attractiveness of cash is a little bit of an illusion, because after inflation is taken into account, it's actually a worse place than it has been for decades, especially when you're looking beyond the short term and to that medium to long term.
Joy, Adam, thank you very much. And thank you for joining us. This video has really been put together as a direct result of questions that we've had from clients. So please do keep those questions coming, and we hope you found that useful. We look forward to seeing you again soon.